Is Canada heading toward a financial crisis? The Bank of Canada recently published a report that raises major concerns about the economic future. With inflation soaring and the economic growth slowing to a crawl, the chance of worst-case scenario have skyrocketed. But what does that really mean for the Canadians? How will it affect your wallet? And most importantly, how can you protect yourself? Stick around as we break down everything you need to know about Bank of Canada's warning and what it means for your financial future. The Bank of Canada's latest report is sending shockwaves across the country. For months now, we've been dealing with the rising inflation and increased costs of goods and services. That leaves your dollar buying less and less, but that's not only concerns anymore. We're now facing the threat of stagnation, a sharp slowdown in economic growth. And then when inflation and stagnation happen at the same time, we get something even worse, a stagflation. A stagflation is a nightmare scenario for any economy because it creates a situation where prices keep rising, but the overall economy is shrinking or stagnant. For Canadians, this means our cost of living is going up, but wages and job growth aren't keeping pace. And according to the Bank of Canada, the risk of this happening has surged. But how did we get here, and what does it mean for the average Canadian? Let's take a closer look. Politicians and economists often use the number GDP, gross domestic product, to measure the health of the economy. The GDP represents a total value of goods and services produced by the country. And when it's growing, it's generally seen as a positive sign. However, focusing solely on GDP can be misleading. GDP doesn't show how the economy is impacting individual Canadians. It doesn't tell us if the wages are keeping up with inflation or if the households can make ends meet. That's why many experts prefer to look at GDP per capita, which measures the economy performance on a per person basis. When GDP per capita starts to stagnate or shrink, it means the economy might be growing, but the average Canadian isn't seeing the benefits. And that's exactly what's happening right now. For the first time since 2008 financial crisis, GDP per capita is dipping below normal growth levels. This struggle that while the overall economy might be expanding slightly, the quality of life for most Canadians is deteriorating. So what does this all mean for you? Rising inflation and stagnation economic growth are creating a scenario where everyday costs are increasing, but your income isn't keeping up. Whether it's buying groceries, filling your car, or paying your rent or mortgage, everything is getting more expensive. And with possibilities of stagnation, there's a little hope that wages will rise to match these growing expenses anytime soon. We're already seeing the effects wages have remaining relatively flat while the cost of living has continued to increase, putting more and more strain on the household budget. For many Canadians, it feels like no matter how hard they work, they're falling behind. This is the real impact of stagflation, an economic situation that's difficult to escape from and even harder to fix. But that's not the only concern. The Bank of Canada has been raising interest rates to combat inflation, which has made borrowing more expensive. If you have a mortgage, car loan, or credit card debt, you likely already felt the pinch of higher interest rates. And with more rate hikes potentially on the horizon, this could even get worse. For homeowners, this is especially worrying. If your mortgage is up for renewal soon, you could face much higher monthly payments due to rising rates. This puts additional pressure on your finances at a time when costs of living is already soaring. As if rising interest rates, inflation weren't enough, global events are making things even more complicated. One of the biggest contributors to our current economic situation is the ongoing conflict in Ukraine. The war has caused major disruptions to the global supply chains, leading to higher prices for food, energy, and worldwide. And because Canada is a major exporter of natural resources, we're feeling the effects of these global trends in a big way. Rising oil prices are having a direct impact on Canadians, whether it's the cost of heating your home or filling up your gas tank. Energy costs are going through the roof, and it's not just energy. Food prices are also rising, making it even harder for families to keep up with everyday expenses. On top of this, supply chain disruptions and changes in global trade policies are putting more pressure on Canadian economy. Canada relies on international trade, and when global markets are unstable, it creates ripple effects that hit us at home. This means that the economic risks we're facing are not just local, but global. and they're becoming harder to predict and control. According to the Bank of Canada's report, the worst case scenario is a prolonged period of stagflation. This would mean several things: job losses and wage stagnation. As the economy slows down, businesses may cut jobs or reduce wages to stay afloat. This would lead to higher unemployment and even less income for Canadian households. Falling housing prices while rising interest rates could cool off the housing market. A sudden drop in house prices could put many homeowners in a tough spot. If you owe more on your home mortgage than the home is worth, you could end up in a situation known as negative equity, which can be financially devastating. Higher debt burdens with interest rates on the rise, the cost of borrowing is increasingly across the board. This means that Canadians with debt, whether it's a mortgage, credit card debt, or car loan, will face higher monthly payments, putting even more strain on household budgets. In this worst case scenario, many Canadians could find themselves financially squeezed from all sides. The cost of living could continue to rise, wages could remain flat, and the debt could become more expensive to manage. And with global uncertainties like Ukraine conflict adding fuel to the fire, there's no easy way out. While the Bank of Canada reports concerning, there are steps you can take to protect yourself and your finances. Here are a few suggestions to consider. Build your emergency fund. If you haven't already known, is the time to start building an emergency fund. Having a financial cushion can help you weather the storm. If you lose your job, face unexpected expenses, or struggle to keep up with rising costs, pay down high interest debt. With interest rates rising, carrying high interest debt is more expensive than ever. Focusing on paying down credit card balances, personal loans, and other higher interest debt to reduce your monthly payments and free up cash. Consider locking into a fixed mortgage rate. If you're a homeowner and your mortgage is coming up for renewal, consider locking in at a fixed rate. This can help protect you from future interest rate hikes and provide more stability in your monthly payments. Diversify your investments. If you're invested in stock market, it's a good idea to diversify your portfolio. Consider adding safe assets like bonds or precious metals to help protect against volatility during times of economic uncertainty. Stay informed. Keep the eye on economic updates from the Bank of Canada and other trusted sources. The more informed you are, the better equipped you'll be to make smarter financial decisions during the uncertain times. At the end of the day, the Bank of Canada is warning us to wake up, call for all of us inflation to not going away anytime soon. And with added threat of stagnation, Canadians need to be prepared for a tough road ahead. It's important to take proactive steps to protect your finances and adjust your changing economic landscape. While we can't control global events like the Ukraine conflict or shifts in global economy, we can control how we respond by staying informed, managing our debt, and building financial resilience. We can navigate these challenging times and come out stronger on the other side. So, what do you think? Are we headed towards stagflation, or is there hope for the quicker recovery? Share your thoughts in the comments below, and don't forget to subscribe for more updates on how the economic trends could impact your financial future. If you found this video helpful, hit the like button, leave a comment. Let's tackle this economic challenge together. Thanks for watching.